Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch.
Hello, everybody. Last week, we talked about how rising government bond yields and the dynamic that the rise in yields was consistently seen as a good thing in the past. It was a symptom of increasingly positive outlook on the economy. But now, increasingly, it's seen as a bad thing. A rise in yields that has a potential to negatively impact risk assets, potentially even negatively impact the recovery through financial conditions if these rises in yields continues. This week, we saw more of the same, where early in the week, markets were fairly stable, but on Wednesday, yields again began to rise globally and for bad reasons. This time was because of expected supply led by the United Kingdom and their budget announcement. I have Ross Walker as our special guest this week, so I'll come back to that event specifically. But higher than expected supply pushed 10-year gilt yields about 9 basis points higher on that day, and this then spilled over into other regions. Then on Thursday, Powell refused to push back strongly against recent rises in US rates, saying, "I don't want to be the judge of any particular interest rate." And then he said they would only be concerned by disorderly conditions or persistent tightening of financial conditions. And while he noted that recent volatility got my attention, that was as far as he went. So from the Fed, this was seen as not a strong pushback, certainly not as strong as the ECB has recently done through their commentary of late. And that led to a further rise in US yields that, again, this was seen as a bad rise. The rise in yields weighed on risk sentiment, as seen in lower emerging markets, lower equities, and boosted the US dollar in a flight to quality move. Note, one thing that we are on watch for, as I said, is the ECB for next week. They have their formal meeting on Thursday. And if they deliver a stronger message than the Fed has here in trying to arrest the current move higher in rates, they could actually have a more positive impact on yields in the Eurozone. We do think that they will be a little bit stronger than their brethren in the US and UK, so keep an eye out for that on Thursday. So that's the central bank side of things, but it turns out that it was also the fiscal side that threw a wrench into the works this week. And again, that was led by the UK, but it also served as a reminder that for other jurisdictions, supply is on a one-way track higher in the bond market, and bond investors face higher supply as a multi-year problem. On that note, I want to turn to our special guest, co-head of global economics and our chief UK economist, Ross Walker. Ross, give me the 10,000-foot view on the budget announcement, focusing first on the implications for the growth outlook.
So the growth outlook, the OBR's, the independent forecasters' numbers are very similar to our own. So I can't really criticize them or quibble with them. So the story is that we get a relatively sprightly rebounding growth in the UK from the second quarter, fueled by partly consumer demand as we move through the year, and thanks partly to some of the budget measures to spur capex. They also have a more marked pickup in business investment in 2022. So the recovery is seen to broaden a little bit as we move through the next few years. And then the interesting part, obviously the early fiscal story is a big giveaway, but there's also some backloaded fiscal tightening.
So two questions following on that. First, some of the economic support policies that have been extended in the near term, is that what's pushing the supply outlook and borrowing needs, or is it broader than that? And then the second question is on the tax side. You know, I'm a cynic when it comes to politicians spending sooner and then promising tax increases later. Do you think those tax increases are likely to go through down the road?
So in terms of the first half of the 5-year forecast, absolutely, it is very much about further COVID-centered support measures. So we have a furlough scheme extension, parallel support for the self-employed, the VAT expenditure tax cut for the hospitality sector, that's extended. There are additional business grants. So the huge and significantly larger than expected fiscal boost in the coming year, almost £60 billion, just over 2.5% of UK GDP, that is overwhelmingly COVID-related support measures. But also bear in mind that in terms of the wider fiscal response over the past year, there has also been a sizable uplift in spending by government departments, notably areas like health and education. So whilst as we move beyond the COVID shock, many of these emergency support measures will no longer be needed. There is also a broader increase in public expenditure, which politically could be difficult to rein in, particularly as the scheduled 2024 election approaches. And so in the context of the backloaded tax rises, you also have some political risk around that. Consumers are being, or the plan is to hit consumers with basically income, inheritance, and pension taxation. Not the headline grabbing rates. The Conservatives' election manifesto had pledged not to do that, but to freeze thresholds, which means the impact might at least initially be a little bit more disguised. People will certainly see this in their paychecks. It is a sizable tax increase that comes from really 2024, 25. And as I say, with the election scheduled for 2024, it may be that some of that gets diluted.
So it sounds like, though, that the market interpretation, which was push gilt yields fairly higher in a fairly substantial way, is probably right, given that mix of definite near-term spending and questionable tax increases down the road. Do you think that's correct?
Yeah, definitely. The huge fiscal expansion over the next year and a half, you'd have a very high degree of confidence around that being delivered. Whether the tax revenues can be generated as planned, as I said, we highlighted some of the issues around the consumer individual taxes and the election, but the government is also relying a lot on a corporation tax yield. And of course, this is a notoriously mobile tax base. So it remains to be seen how much of that is actually generated. It wouldn't be the first time we'd had a set of medium-term fiscal correction projections, which never quite materialized. But the move in yields, as you say, is exactly what you would have expected, given this huge increase in supply. Thus far, the Bank of England, I'd say the response has been minimal. It's been similar to the Fed's. It's possible that central bankers take a benign neglect approach around these longer-term yield moves. But I think we're now in the UK getting into the sort of territory where there is already a meaningful monetary tightening beginning to be priced. And I don't think longer dated yields can go much higher before the BOE will have to intervene rhetorically. And I think the budget will increase the pressure on them to do that.
Yeah, it is something that is definitely consistent across jurisdictions, is that fiscal authorities pressuring spending, pressuring bond yields higher, or at least part of the story, and seeing how different central bankers respond. All right, well, thank you, Ross. I really appreciate that. Thanks for joining us. And thank you, everyone else. We'll talk to you next week.
I hope you have enjoyed this episode of The Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.